All right, let's dive right in. Right now, the entire crypto world is staring at one single number. It's a price that has both the bulls and the bears locked in this massive billion-dollar showdown. So we're going to break down this high-stakes fight and figure out why everyone's drawing completely different battle lines on the exact same chart.
And that number is $112,000. Yeah, after a pretty nasty drop, Bitcoin has landed right on this critical line in the sand. This isn't just any number. It's a huge historical support level, and you can bet the entire market is holding its breath, waiting to see what happens next.
And that really gets us to the core question here, doesn't it? Is this the spot where buyers finally step in, say enough is enough, and build a solid floor, or is this just a little pause before the bottom completely falls out and we see a much, much bigger crash? To get a handle on this, we really need to understand why this specific moment is so critical. I mean, the future of this whole bull market could literally be decided in the next few days. The stakes just couldn't be any higher.
Now here's what's so wild. You have all these brilliant analysts, right? And they're all looking at the exact same chart, the same data, but they're coming up with two completely opposite predictions for the future. So what we're going to do is walk through the absolute strongest arguments from both camps, the bears, who are screaming that a disaster is coming, and the bulls, who think this is a golden opportunity.
Let's kick things off with the bears. From their point of view, the warning signs are just flashing bright red all over the place. They're convinced a really significant plunge isn't just a possibility, it's right around the corner.
You see, the bear case isn't just based on one thing. It's a whole bunch of scary signals firing off at once. That key upward trend line that's been holding the price up for months? Yeah, that's broken. The chart has formed what traders dread, a classic double-top reversal pattern. On top of that, you've got key momentum indicators like the MACD turning negative, the big institutional ETFs are actually seeing money leave, and everybody's on edge about what the Fed is going to say next. For the bears, this looks like a perfect storm.
So what exactly is this double top that has everyone so spooked? Well, think of it like the letter M on a chart. The price hits a peak, pulls back a bit, and then tries to rally back to that same high, but it fails. That failure is a huge red flag for traders. It basically screams that the buyers are exhausted and a major trend reversal to the downside could be coming.
And we are not talking about a small dip here. As analyst Trader Chenge points out, if this critical support at 112 grand gives way, it could trigger even more complex bearish patterns. He's looking at another one, a formation called a shark pattern that sets a price target all the way down at $94,900.
And you can see here how this could all start to snowball. If 112K fails, the bears are first looking at the next support level around $105,000. If that can't hold the line, then the big psychological number $100,000 comes into play. And if the selling gets really ugly, that pattern target of just under $95,000, well, that becomes a very real possibility. But okay, that's only one side of the coin. Now let's flip it over and look at the counterargument, because the bulls are painting a completely different picture. They don't see a collapse. They see a necessary and healthy washout, something that's actually building a much stronger foundation for the next big move up.
So this is where it gets really interesting, how the bulls look at the exact same data and see the complete opposite. What the bears call it dangerous double top, the bulls call that a simple test of a strong historical support zone. Where the bears see a broken short-term trend, the bulls are pointing to the much more powerful long-term moving averages, which are still holding up just fine. And that failing momentum, bulls say that's just a much-needed flush out of all the risky, high-leverage traders.
This confidence is captured perfectly by the analyst Fu Liao B. He says, quote, "The probability of an effective breakdown is not high. It might wick below, but it will come back up quickly. I am not pessimistic." So he's basically saying even if the price dips for a second, buyers are going to rush right back in and defend this level. And there's another piece to the bullish puzzle here, Ethereum. You see, while Bitcoin is looking a little shaky, its closest rival, Ethereum, is actually looking pretty strong. It's holding its own support levels way better, and some see that as a really positive sign for the health of the entire crypto market.
Okay, so we've got the short-term battle lines drawn. Now let's zoom out, way out. Because underneath all this daily chart chaos, there's this massive, powerful, historical pattern that has pretty much dictated Bitcoin's price for over a decade. And that is the 4-year cycle.
So the whole theory is built around Bitcoin's halving, this programmed supply shock that happens about every 4 years. And if you look back, the pattern is kind of hard to ignore. After the 2012 halving, it took about a year for the market to hit its peak. After 2016, it was 525 days. After 2020, 553 days. So yeah, the cycles are getting longer, but the pattern of a monster bull run after every halving has never failed.
But, and this is the billion-dollar question, do those old rules still apply? The people who say yes argue that the basic driver, that halving supply shock, is still there, and hey, the pattern has never been broken. But the no, this time is different crowd, has a really powerful argument. We now have huge institutional money pouring in through ETFs. And these guys are thinking in 10 to 20-year horizons, not 4-year cycles. Plus, for the first time in history, Bitcoin hit a new all-time high before the halving even happened. That's a major break from the script. So this is the huge macro question that's hanging over everything we're seeing on the charts right now. Has this flood of new, long-term institutional money finally broken Bitcoin's predictable, clockwork-like historical rhythm for good? Okay, so you have the market completely split on the short-term picture and split on the long-term cycle. So, what on earth is anyone supposed to do? Well, let's shift from just analyzing to taking action, because there's one thing that every single one of these analysts agrees on. Seriously, through all of this chaos, all the conflicting opinions, every analyst we looked at, from the biggest bear to the biggest bull, said the exact same thing. In a market this choppy and uncertain, disciplined risk management isn't just a good idea, it is absolutely everything.
So here's the universal playbook. Number 1, control your leverage. In a market like this, high-risk positions are just a recipe for getting wiped out. 2, set your stop loss. Know exactly where you're getting out if a trade goes wrong before you even click the buy button. 3, wait for confirmation. Don't be a hero trying to catch a falling knife. Wait for the market to actually show you which way it's going. And finally, number 4, have a trading plan, and for goodness sakes, stick to it. Make your moves based on a strategy, not on fear or greed.
And that really leaves us with one final thought. Depending on which side of the argument you find more convincing, the scary short-term charts or the hopeful long-term cycles, this exact moment could be seen as a point of maximum risk, or maybe, just maybe, it's a moment of maximum opportunity. The only question is, which one is it?